We're seeing a number of interesting deals in the market. The complexity remains high in terms of the transactions. We're looking at a number of bank bond deals, a number of complex refinancings. We continue to see private equity sponsors taking the initiative and using what remains a relatively good market to do acquisitions and or refinancings of their existing portfolio debt. We act for many of the significant lead arrangers in the market. Our flow of information suggests that there is somewhat a backlog of commitments, but we would anticipate that that backlog will clear and that the market will open again actively after the summer. Recent trends in deal terms suggest that the private equity sponsors still have somewhat of the upper hand in terms of negotiating. But that being said, the credit issues which lenders remain focused on are total leverage, the deleveraging story, management of fixed charges, and ensuring structural integrity with the credit. I think that reflects a fair balance between the interests of lenders and borrowers. We suspect that there will remain a relatively good deal of flexibility for top-tier sponsors in the market, and that lead arrangers continue to compete very aggressively for their business. We don't see any dramatic changes in market terms occurring, rather a gradual evolution. That's domestically. Internationally, we continue to see interesting and vibrant markets in Asia. Our colleagues in Asia did one of the few so-called dim sum bonds, which are RMBS denominated bonds out of Hong Kong. Our colleagues in London and Europe remain very active, although they face similar economic conditions as we do. And the markets, continue to remain open for new deals and continue to remain open for refinancings in Europe, and we continue to see a good deal flow in those jurisdictions. The outlook for leverage finance in the United States remains relatively robust going through the third quarter and into the fourth quarter of this year. We continue to see what we feel is a steady drumbeat of market activity. That being said, the larger macroeconomic issues which we're seeing, such as potential sovereign defaults, would be potentially result in a radical series of cascading events in the leverage finance market, which are difficult to predict at the moment, but which we remain very focused on. The outlook also will be contingent on general growth in the United States and valuations for private equity firms in particular of their assets. Our M&A teams see a robust pipeline there, and so we would suggest that leverage finance would correlate with what they're projecting as well. Clients need to be actively engaged with preparing themselves for a number of different potential scenarios in the market. To some extent, if you're risk averse, now is the time to start looking hard at your exposure in the debt markets if you believe that there are potentially adverse sovereign risk events which could materialize in the coming months. That being said, constantly engaging with your potential providers of debt financing, understanding and working with your external advisors, whether that's your legal team, your accountants, your tax advisors, to optimize your debt structure is something that we would always encourage our clients to do. We do that with our clients. We want to make sure that they're seeing the best opportunities in terms of leverage finance, whether we're acting for the borrower, the private equity firm, or the lead arranger. We think that there is a sense of optimism in the market, but it is cautious optimism, and assisting our clients to execute on great transactions and on financings which are highly tailored to their needs is something that we continue to see going forward.